Now speaking, Lawrence Kurzius, Chairman and Chief Executive Officer. Good morning everyone, thank you for joining today's call. We are pleased to share that last night we announced that Brendan Foley will become McCormick's next Chief Executive Officer on September 1st, and he is joining the Board of Directors immediately. This transition has been planned internally as part of an orderly multi-year succession plan. We are also pleased with our strong second quarter performance, which reflects sustained demand across our business and effective execution of our strategy. We delivered double-digit constant currency sales growth, our pricing actions are in place and volume performance improved. We drove year-over-year margin expansion in both segments, underscoring our focus on profit realization. Additionally, we grew adjusted earnings per share by 25%, driven by significant adjusted operating income growth. Year-to-date cash flow from operations more than doubled, driven by higher earnings and working capital improvements. Both segments in all regions contributed to strong growth. Our results benefited from our recovery in China, and we are confident in the contribution China will provide to our results as the year progresses. Moving forward, we are raising our adjusted operating income and earnings per share outlook for the full year based on our strong results and continued demand across our portfolio. Thank you for your attention. I now turn it over to Brendan for his segment update. Now speaking, Brendan Foley, President and Chief Operating Officer. Thank you. In the second quarter, our underlying sales growth was 6%, driven by strong performance in both our Consumer and Flavor Solutions segments. Our pricing helped to offset cost inflation and enabled us to deliver our 9th consecutive quarter of double-digit constant currency sales growth in Flavor Solutions and 7% growth in the Consumer segment. Our focus on cost management, leverageable infrastructure investments, and supply chain optimization drove a 150 basis point improvement in adjusted operating margin in the quarter. We achieved these results despite an incremental $18 million of COVID-related costs, including higher labor costs, new safety protocols, and increased packaging materials. Looking ahead, we remain confident that our strategy will drive sustainable, profitable growth well into 2024 and beyond. Now speaking, Mike Smith, Executive Vice President and Chief Financial Officer. Good morning, everyone, and thanks for joining us for today's quarterly earnings call. We are pleased to report that our second quarter was a strong one, with 10% constant currency sales growth, 310 basis points gross profit margin expansion, 36% increase in adjusted operating income, and 3-5% growth in adjusted EPS. Our top-line sales growth was driven by pricing actions and partially offset by volume declines due to the Kitchen Basics divestiture, exiting of our consumer business in Russia, and strategic decisions we made related to optimizing the profitability of our portfolio. In addition, our Flavor Solutions segment grew 13%, driven by both pricing and volume increases from the lapping of the prior year COVID-related disruption in China. Gross profit margin expanded significantly, reflecting our unwavering focus on increasing profit realization, and selling, general and administrative expenses increased as higher employee incentive compensation expenses and distribution costs were partially offset by CCI-led and Go savings. At the bottom line, second quarter 2023 adjusted earnings per share was 60 cents compared to 48 cents in the year-ago period, driven by higher adjusted operating income and partially offset by higher interest expense and a higher effective tax rate. For fiscal 2023, we continue to expect 5 to 7% sales growth and are raising adjusted operating income and adjusted earnings per share guidance, driven by our strong year-to-date performance, combined with the robust demand we continue to expect and our diligent approach to optimizing our cost structure. We expect to drive margin expansion with strong sales and adjusted operating income growth that reflects the health of our underlying business performance, as well as the net favorable impact from several discrete drivers. We expect our adjusted operating profit growth will be partially offset below operating profit by higher interest expense and a higher projected effective tax rate. Now speaking, Brendan Foley, President and Chief Operating Officer. I am pleased to present our quarterly earnings call today. Global demand for flavor remains the foundation of our sales growth, and we have intentionally focused on great, fast-growing categories. Our alignment with long-term consumer trends, healthy and flavorful cooking, increased digital engagement, trusted brands, and purpose-minded practices continues to create a tailwind for growth. We are uniquely positioned to capitalize on this demand for great flavor. With the breadth and reach of our strong global flavor portfolio, we are delivering flavor experiences for every meal occasion. As we look ahead to the back half of the year, we will continue to focus on capitalizing on strong demand, optimizing our cost structure, and positioning McCormick to deliver sustainable growth and long-term shareholder value. We have compelling growth plans in place, including building momentum with our new products and heat platform. Our fundamentals remain strong, and we expect to continue to not only deliver strong sales growth, but also drive total shareholder return at an industry-leading pace. We want to thank Lawrence for his mentorship and continued service to McCormick. During his time as CEO, we have grown sales over 50% and market capitalization more than doubled, creating significant shareholder value. We have prioritized investing to drive future growth, increased our profit realization, improved cash flow from operations, and have returned more than $2.5 million to shareholders. Lawrence is widely credited with embedding purpose-led performance into McCormick's culture by championing the company's industry-leading sustainability efforts, driving a period of tremendous growth, performance, and expansion, including acquisitions of iconic brands like Frank's Red Hot, French's, Cholula, as well as FONA, and successfully leading McCormick through the unprecedented global pandemic. We are confident that with successful execution of our plans and concrete actions, we will realize the profitable growth reflected in our updated 2023 financial outlook. We look forward to continuing to deliver long-term differentiated growth. Barclays analyst Andrew Lazar inquired, "My question is, what are the key strategies that you plan to implement in order to ensure continued success for McCormick?" What strategies do you plan to implement to ensure McCormick's continued success? Lawrence Kurzius replied, "Andrew, thanks for bringing up McCormick's leadership development and succession planning. We've been thoughtful and deliberate in this multi-year process so that Brendan, our newly appointed president, could take the helm as CEO. His disciplined approach to delivering growth is exactly what you'd expect from McCormick. We gave everyone an opportunity to get to know him and understand his qualities." Barclays analyst Andrew Lazar inquired, "Could you provide some color on the change in marketing outlook between 1Q and now?" Lawrence Kurzius replied, "We're confident in our outlook for the back half of the year. Our year-to-date performance has been strong and we've increased our guidance accordingly. However, we're mindful that there are still some puts and takes within the business overall, especially with the slower recovery in China than we expected. We want to remain prudent in our expectations for the coming quarters." Barclays analyst Andrew Lazar inquired, "What drivers do you anticipate will bring positive volume growth in the back half of the year?" Lawrence Kurzius replied, "I expect our volume performance to improve this year, with a slightly softer outlook in China. We anticipate overall volumes will be flat, plus or minus 1%, in the second half of the year." Brendan Foley replied, "In the Americas, we're performing as planned. Sequential improvement is seen across the portfolio month to month and quarter to quarter, excluding the exit of the DSD business which had a 2-point impact in Q2. In China, we anticipate a strong recovery that is less than initially expected. In EMEA, volume growth is seen despite the exit of Russia with underlying mix and volume being favorable. The DSD exit was due to the unprofitability of the business and will have an impact for the rest of the year." J.P. Morgan Chase & Company analyst Ken Goldman inquired, "What is your assessment of customers' inventory levels and potential risks of retail safety stock deloads as the supply chain normalizes?" Brendan Foley replied, "Ken, thanks for your question. We're not experiencing any unusual or significant trade inventory destocking. The difference between our sales and consumption was mainly due to the retail sell-through of discontinued items and higher listing fees associated with launching new products. We anticipated our alignment between consumption and shipments normalizing and there's nothing unusual occurring this quarter." Lawrence Kurzius replied, "Our service levels have been consistently strong and retailers have had time to adjust their stock accordingly. This has been occurring for the past year and a half." J.P. Morgan Chase & Company analyst Ken Goldman inquired, "How is the Flavor Solutions business in Europe performing in the current quarter? Are customers such as food, beverage, and QSR seeing softness or worsening conditions?" Brendan Foley replied, "Ken, the Flavor Solutions side of our business in EMEA is seeing softer demand than anticipated. This seems to be due to a reduction in consumer demand from the quick-serve restaurant customer channel, likely because of inflationary pressures in Europe. This has had an impact on our overall volume rate for the region." Mike Smith replied, "Approximately 1/3 of our volume decrease was due to us exiting 2 private label service lines. This was a strategic portfolio optimization." Lawrence Kurzius replied, "Yes, we anticipated this at the start of the year and took it into consideration when developing our plans. While we couldn't be transparent about it for customer relations reasons, it was part of our." Bank of America Merrill Lynch analyst Peter Galbo inquired, "What were the results of Memorial Day grilling and what can you tell us about your expectations for the summer and America's consumer, particularly grilling?" Brendan Foley replied, "Thanks for the question, Peter. Q2 was a strong start to our grilling season. We have a solid innovation plan in place and are now well supplied with mustard, Frank's Red Hot, Lawry's marinades, enabling us to resume normal promotional activity. Together, these factors have resulted in good market share growth in the second quarter." Bank of America Merrill Lynch analyst Peter Galbo inquired, "What can we expect for gross margins for the rest of the year given the current inflation guidance?" Mike Smith replied, "Yeah, Peter, we raised our guidance on gross margin 25 basis points to 75 basis points, from 50 to 100. We've seen increased pricing realization in our Go program, and the 300 basis point improvement in the second quarter compared to last year was our best performance of the year. We expect further improvements for the back half, although not as large as the 300 basis point improvement. Bank of America Merrill Lynch analyst Peter Galbo inquired, "Could you please explain your thoughts on margin improvement in the second half of the year?" Mike Smith replied, "Based on our mix of business, margins tend to be higher in the back half of the year, particularly in Q4. Our guidance is for up to a 90 basis point improvement, with a low at 0. We anticipate a strong recovery in China for Q4, which benefits us due to our scale and margin advantages there." Lawrence Curzius replied, "We are confident that our gross margin and operating profit margins will continue to improve as we move through the year." Lawrence Curzius replied, "Peter, our focus is on optimizing our portfolio. We've determined that exiting DSD business was in our best interests. The products we are selling, spices and dried peppers and settle bags, move through unscanned channels and have a low value. However, our major customers still require these products, so we will continue to sell them through the warehouse where margins are attractive and profitable." Sanford Bernstein analyst Alexia Howard inquired, "What inning are we in for regaining lost U.S. retail distribution, and what kind of tailwind could that be over the next year to 18 months? Brendan Foley replied, "Alexia, I'm pleased to report that our performance and overall trends in the second quarter have been positive. We anticipate continued progress as customers reset their shelves and our category management efforts start to take effect. We're investing in this effort for both this year and next, though it's too early to quantify the results yet. We're also confident that our overall distribution points will continue to improve over the course of 23 and 24, even though roughly half of the points lost were due to discontinuations." Lawrence Curzius replied, "Our innovation, combined with the restoration of our U.S. everyday spice line, is expected to yield greater distribution and customer wins in Q3. This should have a positive impact on our TDP, and we remain confident that we will see improvements throughout the year." Mike Smith replied, "We anticipate a mid-single-digit increase in brand marketing spending in the second half, primarily in the third quarter." Sanford Bernstein analyst Alexia Howard inquired, "Can you provide an overview of the one-time costs that will be eliminated by 2024? Mike Smith replied, "You're referring to our dual running costs in our EMEA region for the new large facility. We expect these costs to be around $20 million this year, comparable to last year. However, we anticipate that half of those costs will go away in the first and second quarter of the transition to the new facility." Deutsche Bank analyst Steve Powers inquired, "What impact, if any, is customer destocking having on your flavor solutions business in the second half of the year?" Brendan Foley replied, "Steve, thanks for your question. Our flavor solutions business has a strong volume 1009 profile, taking into account the exit discussions and other impacts. We are focusing on areas with healthy growth, such as performance nutrition, seasonings, and health and nutrition. We believe our volume profile reflects this composition, and we're not seeing any broad restocking discussions with customers at this time." Lawrence Curzius replied, "I agree that customer wins are driving market share gains for us. This is a positive factor for our company." Mike Smith replied, "Our flavor solutions business has seen tremendous growth due to the innovative products we have introduced. Our continued focus on innovation has increased volume and margin." Deutsche Bank analyst Steve Powers inquired, "Can you provide an update on flavor solutions margin recovery and frame how you expect that to progress in the second half?" Mike Smith replied, "I'm pleased to say that our margin progress has been strong. Our flavor solutions margins were around 14% pre-pandemic, and we expect to get back to this level in the longer term due to portfolio migration. We had a good second quarter, showing sequential improvement, and though there will be some lumpiness from quarter to quarter based on run costs, we are bullish on the recovery of flavor solutions." Lawrence Curzius replied, "We're thrilled with the 280 basis point expansion in operating margin this quarter. This was a significant increase that has driven our decision to raise op guidance for the year. We are excited about the progress we are making in both our segments." Exane BNP Paribas analyst Max Gumport inquired, "Can you provide clarity on why the updated guidance range implies that gross margin may not reach pre-pandemic levels in the second half of the year?" Mike Smith replied, "Max, what we've seen in the past 2 years is a dilution of our gross margin due to pricing that didn't cover our costs. This has been a headwind with an impact of up to 300 basis points. We are still seeing some of this effect, but we anticipate reducing the dilution with our CCI programs and more normal cost inflation in the future. Despite this, we have seen an upward trajectory in gross margin in the second quarter, giving us confidence for the future." Exane BNP Paribas analyst Max Gumport inquired, "Can you provide an update on the recovery of your TDPs in U.S. spices and seasoning, and how we should expect to see dollar share improve as the year progresses?" Brendan Foley replied, "Yes, we've seen an increase in sales volume and unit growth across our portfolio, particularly in America-based spices and extracts. We have invested in brand marketing, category management, and innovation. This has allowed us to focus on sustainable growth and gain a compounding effect from those investments. We expect that profile to improve in the back half of the year due to increased distribution, brand marketing, category management, and innovation. This trend is also being seen in Europe, so these are areas which we are continuing to put a lot of focus on. Overall, everything is moving in the right direction and we feel optimistic about our external performance off-shelf. Lawrence Curzius replied, "We have seen share gains in Europe, Australia, Asia and our other categories, such as spices and seasonings. In the US, we are confident that we will continue to gain market share using the same playbook that has been successful for recipe mixes." Goldman Sachs analyst Adam Samuelson inquired, "Your question: what headwinds on a year-on-year basis from incentive comp have been realized in the first half of the year, and what is the expected impact of price cost and mix on gross margin improvement in the second half of the year?" Mike Smith replied, "Yes, regarding SG&A and incentive bill back, we saw a portion of it in Q2 with the remainder occurring during the second half. As for gross margin, we are confident yet prudent. We have made progress on our GO program, pricing realization is highest in Q1 and dips in Q2, and cost inflation is low to mid-teens. We expect to see improvement in gross margin, but remain cautious." Lawrence Curzius replied, "Our gross margin in our underlying business has historically been higher in the third and fourth quarters. This is a result of the mix of our business and is expected to continue this year as we anticipate improvement versus prior year margins in both of these quarters." Goldman Sachs analyst Adam Samuelson inquired, "What is the expected gross margin percentage for the second half of the year?" Mike Smith replied, "Adam, we're pleased to note that our gross margin improved 113 basis points in the first half of the year compared to last year. We expect to sustain this progress with a 40 to 50 basis point improvement in the second half of the year. Last year's second quarter saw 300 plus basis points increase, which contributes to the higher first half numbers. We're confident in our ability to maintain these positive results." Stifel Financial Corporation analyst Matt Smith inquired, "What impact do you expect new product launches and marketing initiatives to have on elasticity in the U.S. for the second half of the year?" Brendan Foley replied, "Consumer pressure has remained consistent. Our price elasticities and performance off-shelf have remained steady since the fourth quarter, even with a retail price increase in April. We don't anticipate any major changes in the consumer trend for the remainder of the year." Lawrence Curzius replied, "I'm confident that consumer demand will remain strong and our growth plans for the second half of the year are robust. We anticipate seeing positive volume gains in our U.S. business throughout the year." Stifel Financial Corporation analyst Matt Smith inquired, "Could you provide an update on the momentum of business in China, and how does the current consumer environment compare to year-ago levels?" Brendan Foley replied, "In terms of sequential improvement, we didn't see any major changes in our performance throughout the quarter. Consumer spending was still strong, but not as robust as hoped, with higher unemployment rates in China. We expect similar trends to carry through into the third quarter, but it won't be as big of a rebound as last year due to the comparison. The fourth quarter will feel more like the second, given the COVID-related lockdowns." Mike Smith replied, "Yes, so in summary, Q3 is a difficult comparison due to the strong recovery China experienced last year. On the other hand, Q4 provides an easier comparison as lockdowns were in place." Lawrence Curzius replied, "The Chinese economy has been on a rollercoaster ride since it reopened. Our team just spent time with the China management team and the overall recovery looks strong. However, we have tempered our outlook for China in terms of growth, which is reflected in our guidance." TD Cowen analyst Robert Moscow inquired, "Can you reconcile the consumer research data which says they prefer brands with the market share data which shows that private label is increasing?" Brendan Foley replied, "We've seen trade down to private label, particularly recently, but this has moderated in our own categories as pricing gaps narrow. We're seeing unit growth trends decelerate, but consumers are looking for value rather than the cheapest option. Our focus is on offering a range of brand and private label options, while also pushing for line size growth to provide greater value. We're not currently seeing the same trade down levels as were observed during earlier inflationary periods." Lawrence Curzius replied, "Thank you to all of you in the analyst and investor community for your insights and perspectives, which have helped shape our strategies and clarify our messaging. We appreciate your constructive and transparent dialogue and have valued the opportunity to exchange ideas and discuss our performance. We are confident that McCormick's alignment to consumer trends, the breadth and reach of our product portfolio, and strategic growth investments will position us for continued success and long-term value for shareholders. Thank you for joining today's call, and if you have any further questions, please do not hesitate to contact me."